You probably think your biggest problem in trading is finding the right strategy. It isn't. For many traders, the real problem begins after they find a strategy, because once you have a strategy, you still have to decide how much you are willing to lose, where you are willing to exit, how much you expect to make, and what you will do when the market does something you did not expect. And this is where something interesting happens. A trader can have a good entry, a good analysis, a good understanding of the market, and still lose money consistently. Not because the market is impossible to understand, but because the trader never understood the relationship between risk and reward. Most traders look at risk to reward as a number: 1 to 2, 1 to 3, 1 to 5. They think if they can find trades offering 3 times what they are risking, they have discovered the secret. But risk to reward is not really about finding a magical number. It is about changing the way you think about a trade. Because the moment you truly understand risk and reward, something inside your trading starts to change. You stop asking, how much can I make? And you start asking, how much am I willing to lose to find out if I am right? That is a very different question, and it can completely change the way you approach the market. Imagine you are looking at a chart. You have been watching it for almost 2 hours. Price has been moving sideways. Nothing interesting is happening. Then suddenly, price starts moving toward an area you have been waiting for. Your attention changes immediately. You sit forward. You start watching every candle. Price reaches the level. For a moment, it looks perfect. You tell yourself, this is the trade. You enter, and then price moves against you. Not dramatically, just enough to make you uncomfortable. You stare at the screen. You tell yourself it will come back. Another candle closes against you. Now you are nervous. You move your stop a little farther away. Just give it some room. Price moves again. Now you are down more than you originally planned. You don't want to close the trade because closing it means admitting you were wrong. So you wait. And this is where a small planned loss can become a large emotional loss. Not because the market forced you to take that much risk, because you changed the agreement you made with yourself before entering. This happens more often than traders want to admit. And there is something psychologically important about it. The trader was not really trading the market anymore. They were protecting their ego. That is one of the biggest differences between an emotional trader and a disciplined trader. The disciplined trader understands something uncomfortable. A loss does not mean you are a bad trader. It means the idea you acted on did not work this time. That's all. You do not need to defend yourself against the market. The market does not know you exist. It is not trying to embarrass you. It is not trying to take your money personally. It is simply moving. Your job is not to control where it goes. Your job is to decide what you are willing to risk before you participate. That is where my approach to risk and reward begins. Before I think about how much I can make, I think about how much I am comfortable losing. Not how much I can technically afford to lose, how much I can emotionally accept losing without changing my behavior. That distinction matters because some traders say they are risking 1%, but the moment that 1% starts disappearing, they panic. They close too early. They move their stop. They enter another trade. They increase their position size. They start looking for another opportunity to recover the loss. Technically, they may have risked 1%. Psychologically, they were risking much more. The real risk of a trade is not only the amount of money that can disappear, it is also what that loss might make you do afterward. Think about that. If losing $50 makes you revenge trade, then $50 is not really your risk. Your risk could become $100 or $200 or an entire week of profits. This is why risk management is not simply mathematics. It is behavior. It is emotional control. It is self-awareness. And this is also why I don't believe a trader should blindly copy someone else's risk percentage. Someone might tell you to risk 1% per trade. Another person might risk 0.5%. Another might risk 2%. But the correct question is not, what percentage does a professional trader use? The question is, what level of risk allows me to execute my plan without becoming emotionally unstable? Because if you cannot think clearly after a loss, your risk is probably too high. And this brings us to something most traders completely misunderstand about risk to reward. You do not need to win most of your trades to make progress. Let that sink in. You can lose several trades and still have a profitable period. Imagine you risk $100 on every trade. You take 10 trades. You lose 6. That's $600 gone. But on the 4 trades you win, you make $300 each. That's $1,200. You lost more trades than you won, yet you finished with $600 before costs and other considerations. This is not a promise that a particular ratio will make you profitable. It is simply mathematics, and the mathematics teaches you something important. You don't need to be right all the time. You need your wins and losses to have a relationship that gives your process a chance to work over a series of trades. That is a completely different mindset. The emotional trader thinks every trade needs to work. The professional-minded trader thinks in groups. Not one trade, not 2 trades, not today's trade, a series. Because one trade is almost meaningless by itself. You can make a perfect decision and lose. You can make a terrible decision and win. That's one of the hardest things for a new trader to accept. Sometimes good decisions lose money. Sometimes bad decisions make money. The market does not reward you immediately for being disciplined, and it does not punish you immediately for being reckless. That's why trading can be so psychologically dangerous. Bad behavior can sometimes produce a good result, and good behavior can sometimes produce a bad result. Imagine you enter a trade without a stop loss. Price moves in your direction. You make $300. You feel brilliant. You think you have discovered something. But what actually happened? You made money from a dangerous decision. The market rewarded the behavior temporarily. That can be more dangerous than losing, because now your brain associates recklessness with success. Eventually, the same behavior can produce a devastating loss. This is why I care more about execution than one individual result. If I followed my plan and lost, I can live with that. If I ignored my plan and won, I should still examine that decision, because I am not trying to become a trader who gets lucky. I am trying to become a trader who can repeat good decisions. And this is where risk to reward becomes powerful. I don't enter a trade simply because I see a possible direction. I want to know where my idea becomes invalid. That is the first thing. Where am I wrong? Not emotionally wrong, technically wrong. If price reaches that point, what was I expecting is no longer reasonable. That is where the stop belongs. And this is an important difference. Your stop loss should not simply be placed at a random distance because you decided you want to risk $50. The market should help determine where your idea is invalid. Then your position size should be adjusted to fit the amount of money you are willing to risk, not the other way around. This is a simple idea, but it changes everything. Many traders choose their lot size first. They say, I am going to trade 0.5 lots. Then they look for somewhere to put their stop. That can create problems. Instead, I want to know where the trade makes sense. Where does my idea fail? Then I calculate how much I need to trade so that if the stop is hit, the loss remains acceptable. The distance to the stop determines the position size. The market determines the technical invalidation. You determine the financial risk. That is a much healthier relationship. Now comes the other side, reward. And this is where traders often become greedy. They see a setup. They calculate that they could potentially make 5 times their risk. So they decide they must hold for 5 times their risk. But the market does not owe you 5 times your risk. A beautiful ratio on paper means nothing if the market has no realistic path to that target. This is why I don't chase large risk to reward numbers, simply because they look impressive. I want the target to make sense. Where is price likely to encounter difficulty? Where has the market previously reacted? Where are obvious highs or lows? Where might other traders be taking profits? Where does the path become less attractive? These questions matter because a target should be connected to the market, not your imagination. Let's say you risk $100. You see an opportunity to potentially make $300. That's a 3-to-1 relationship. Fine. But if the market is likely to run into a major obstacle before reaching that $300 target, then the 3-to-1 ratio is not necessarily a great trade. It is just a number. And numbers can lie when they are taken out of context. This is something traders often miss. Risk to reward is not about maximizing reward. It is about finding a reasonable balance between what you are risking and what the market realistically gives you room to pursue. Sometimes the best trade is one that offers 2 times your risk. Sometimes there may be a larger opportunity. Sometimes there is no trade at all. And that last one is important because traders feel like they always need to participate. They wake up, they open the charts, they see movement. They feel like they should be doing something. But movement is not an invitation. A candle moving quickly does not mean you should enter. A market reaching a level does not mean you should enter. A friend making money does not mean you should enter. The fear of missing a move is one of the most expensive emotions in trading because FOMO makes you enter after the opportunity has already changed. You see price running. You think, if I don't enter now, I'll miss it. So you enter, your stop is awkward. Your target is unclear. Your risk is larger than normal. And now you are no longer making a calculated decision. You are paying an emotional tax for being late. Think about how different the same market looks when you are patient. Price moves, you watch. Price reaches an area that interests you, you wait. Maybe it reacts, maybe it doesn't. Maybe you get your confirmation, maybe you don't. And sometimes you do nothing. That is not failure. That is trading. A fisherman does not throw his net into the water every 5 minutes because he is afraid the fish will disappear forever. He waits for conditions that make sense. The market will still be there tomorrow. You don't need to catch every move. You only need to participate when the conditions make sense for you. And once you understand this, risk to reward starts becoming much easier because patience improves your risk. When you stop forcing entries, you can wait for locations where your invalidation is clearer. And when your invalidation is clearer, your risk can become more controlled. And when risk is controlled, you can think more clearly about reward. Everything connects. But there is another psychological trap, taking profits too early. This one is painful because it often comes from fear. You enter, price moves in your favor. You are up $70. Your target is $200. Then price pulls back. You become uncomfortable. You think, what if it gives everything back? So you close, you take the $70, then price continues to your original target. You watch it happen. And now you are angry. You say, I knew it, but did you? You knew your analysis was pointing toward the target. You simply could not tolerate the temporary uncertainty along the way. This is one of the hardest lessons in trading. A profitable trade can still make you uncomfortable because markets rarely move perfectly from your entry to your target. They move, they pull back, they pause, they test levels, they create doubt. And if your entire emotional state depends on watching your profit number increase every second, you will struggle to hold good trades. This is why I prefer to define the trade before entering. Where am I wrong? Where am I taking profit? What would make me exit early? What would not? I want these decisions made while I am calm, because the version of me who enters a trade is usually more rational than the version of me who is staring at a floating loss or profit. The moment money is moving on the screen, emotion enters the room. That's why preparation matters. You are not trying to become emotionless. You are trying to make fewer important decisions while emotional. There is a difference. You will feel fear. You will feel excitement. You will feel disappointment. You will want to interfere. The goal is not to eliminate those feelings. The goal is to stop allowing every feeling to become an instruction. Fear can say, close the trade. You don't have to listen. Greed can say, increase the target. You don't have to listen. Revenge can say, get the money back. You don't have to listen. FOMO can say, enter now. You don't have to listen. That is discipline, not the absence of emotion. The ability to feel emotion without automatically obeying it. Now think about what happens after a loss. This is where many traders destroy themselves. You lose a trade, you feel disappointed, and you see another setup. But deep down, you are not really taking that setup because it meets your criteria. You are taking it because you want your money back. That is revenge trading. And revenge trading has a very specific psychological pattern. The first trade was about the market. The second trade becomes about you. You are no longer asking, is this a good opportunity? You are asking, can this trade fix what just happened? That's dangerous because now you need the market to give you something. And the moment you need the market to give you something, you become emotionally attached to the outcome. A professional mindset is different. The loss happens. You accept it. You step back. You evaluate whether the decision was valid. If another opportunity appears and it genuinely meets your criteria, you can take it. If it doesn't, you don't. The previous loss has nothing to do with the next trade. The market does not know that you lost $100 10 minutes ago. It does not care. So why should your next decision be based on it? This is why I like fixed, controlled risk. When each loss is small enough to accept, you don't feel the same urgency to recover. You can breathe. You can wait. You can think. That is the hidden benefit of good risk management. It doesn't just protect your account. It protects your mind. And once your mind is protected, you make better decisions. Now let's talk about the risk to reward strategy itself in a practical way. Suppose I find a setup that I genuinely understand. I have a reason for the entry. I know what price needs to do for my idea to make sense. I know where the idea becomes invalid. Let's say that invalidation means I could lose $100. That is the maximum amount I have accepted before entering. Now I look toward the potential target. Maybe the realistic target is $200. That gives me a 2-to-1 relationship. If the setup is otherwise strong and the market has enough room to reach that area, I can consider the trade. Maybe another setup offers $300 of potential for the same $100 risk. That is attractive, but I don't automatically choose it just because 3 is bigger than 2. I ask whether the market can realistically reach that target because the best looking ratio is useless if the target is unrealistic. And there is another thing I look at. How much space is there between my entry and my stop? This matters because a very tight stop can look attractive mathematically. You might think, I am only risking $50 to make $250. 5-to-1. Amazing. But if the stop is sitting in a place where normal market movement can easily reach it, that ratio means very little. The market can remove you from the trade before the idea has time to develop. So again, the number is not the strategy. The logic behind the number is the strategy. This is why I don't want traders obsessing over one magic risk to reward ratio. I want them understanding the relationship. Risk should be small enough to survive. The stop should be placed where the trade idea genuinely fails. The target should be based on a realistic market objective, and the position size should be adjusted so the loss remains controlled. That's it. Simple, but simple does not mean easy, because the hardest part is not calculating the numbers. The hardest part is respecting them. You can calculate your risk in 30 seconds. Respecting it can take years, because respecting risk means accepting that your beautiful analysis can still be wrong. It means accepting that sometimes price will move exactly as you expected after stopping you out. That one hurts. You enter, price hits your stop, you feel frustrated, then 5 minutes later, the market turns and travels directly toward the target you originally had. You think the market hunted my stop. Maybe your stop was simply too close, or maybe the timing was wrong, or maybe your entry was early. The important thing is not to immediately create a story that protects your ego. Ask better questions. Was the risk placed logically? Was the entry too early? Did I enter because I was impatient? Was there a better confirmation? Did I choose the trade because I genuinely saw an opportunity or because I wanted action? Those questions make you better. Blaming the market doesn't. There is another thing traders need to understand. You are going to have losing streaks, not because your strategy is broken, because probability does not guarantee a smooth sequence. Even a strategy with an edge can produce several losses in a row. This is why your risk must be designed for losing streaks, not just winning streaks. Anybody can handle risk management when they are winning. The real test comes after 3 losses, 4 losses, 5 losses. What happens to you then? Do you increase your lot size? Do you abandon your strategy? Do you start taking random trades? Do you start watching other traders and copying them? Do you suddenly decide that the market is manipulated? Or do you remain the same trader? That is where you discover whether your risk model actually fits you. If 3 losses make you desperate, your risk is probably too aggressive. If 5 losses make you abandon your process, you probably expected too much certainty. A mature trader understands that uncertainty is part of the business. You don't get paid for knowing what happens next with certainty. You get paid, if you are successful, for making decisions where the potential reward justifies the risk, and then managing yourself consistently over many opportunities. That is a completely different game. And perhaps the biggest shift happens when you stop measuring yourself by money. Of course, money matters. We're trading for a financial result. But if you stare at your account balance after every trade, your emotional state will rise and fall with every candle. You win. You feel intelligent. You lose. You feel stupid. You win again. You feel unstoppable. Then you lose. You feel like quitting. That's exhausting. Instead, measure yourself by execution. Did I wait for my setup? Did I enter where I planned? Did I calculate the risk correctly? Did I respect my stop? Did I respect my target? Did I avoid revenge trading? Did I avoid taking a trade because I was bored? Did I follow my rules even when I was afraid? Those are the things you can control. And that brings us to something very important. The goal of risk management is not to prevent losses. You cannot do that. The goal is to make losses survivable. There is a huge difference. You cannot build a trading career by trying to eliminate every losing trade. You build one by making sure losing trades do not eliminate you. Think about a boxer. A good boxer doesn't assume they will never get hit. They protect themselves because they know getting hit is part of the fight. Trading is similar. You don't need to create a system where you never lose. You need a system where losses do not destroy your confidence, your capital, or your ability to continue making rational decisions. That is why I would rather take 10 small losses than one massive emotional loss. Small losses teach, massive losses damage. Small losses leave you able to come back tomorrow. Massive losses can make you desperate. And desperation is one of the worst states to trade from. When you are desperate, every candle looks like an opportunity. Every pullback looks like a chance to recover. Every loss feels personal. Every win feels like relief. You stop trading probabilities. You start gambling with hope. And hope is not a risk management strategy. This is also why leverage needs respect. Leverage can make a small market movement create a large change in your account. That can be useful when controlled. It can also become destructive when position size is too large. The question is never, how much can my broker allow me to trade? The question is, how much can I responsibly risk? Your broker's maximum is not your personal maximum. The market may give you the ability to take enormous positions. That does not mean you should. A professional mindset often looks boring from the outside. Small risk, few trades, lots of waiting, little excitement, no dramatic revenge trade, no doubling down because of a loss, no giant position because you feel confident, no change in the plan every 20 minutes, boring. And that is exactly why it works psychologically. The trader is not trying to create excitement. They are trying to create consistency. You may have noticed something strange about experienced traders. They often don't look excited when they win, and they don't look devastated when they lose. That doesn't mean they don't care. It means they understand that one outcome does not define them. A win is information. A loss is information. A mistake is information. The goal is to collect enough information over time to become better. This is why your trading journal matters. Not because you need another spreadsheet, but because memory is emotional. After a loss, you remember the pain. After a big win, you remember the excitement. But when you record your trades, you can start seeing patterns. Maybe you discover that your biggest losses happen after your first loss of the day. Maybe you discover that you close winning trades too early. Maybe you discover that your best trades happen during a certain period. Maybe you discover that most of your bad trades were not really setups at all. They were impulses. That kind of information is valuable because you cannot improve what you refuse to observe. And eventually, you start seeing something deeper. Your biggest enemy was never the chart. It was the version of you that needed the chart to behave a certain way. You wanted certainty. The market gave you probability. You wanted immediate results. The market demanded repetition. You wanted every trade to work. The market reminded you that losses are unavoidable. You wanted to control the outcome. The market gave you control only over your decisions. And that is the real lesson behind risk to reward. It teaches acceptance. You say, before entering, I am willing to lose this amount. That sentence sounds simple, but psychologically, it is powerful because you are accepting uncertainty before uncertainty arrives. You are saying, I don't know what happens next, and that is okay. I know what I will do if I am wrong, and that is enough. I know where I want to take the trade if the market moves in my favor, and that gives me a plan. This removes a huge amount of emotional chaos because you are no longer negotiating with yourself while the trade is moving. You already decided, and there will still be moments when you want to interfere. Of course there will. You might watch price come close to your stop, your stomach tightens, you think about moving it, but then you remember, this was the risk I accepted. You let it happen. Maybe price hits the stop, you lose. You breathe, you move on. That is progress. Not because you won, because you kept your word to yourself. And that is something traders don't talk about enough. Every time you break your own rules, you teach your brain that your rules are optional. Every time you follow them, even when the result hurts, you build trust in yourself. That's how discipline develops. Not through motivation, through repetition. You become disciplined by repeatedly doing what you said you would do. Eventually, your brain begins to understand, my plan is not something I change because I am uncomfortable. And that changes you. You become calmer. You stop needing to stare at every tick. You stop chasing. You stop trying to predict every movement. You start waiting, and waiting becomes easier because you know that missing a trade is not the same as losing money. This is another major difference. A missed trade costs you nothing. An emotional trade can cost you much more. Yet, traders often fear missing trades more than they fear taking bad trades. Why? Because they imagine the profit they could have made. They see price move without them. They calculate the money that was there, but that money was never theirs. It was only a possibility. The trade you didn't take cannot hurt your account. The trade you took without a plan can. So sometimes the most profitable decision you make is the decision to do nothing. And that can feel uncomfortable at first because doing nothing doesn't give you the emotional reward of action. But trading is not about being busy. It is about being selective. You are not paid for the number of buttons you press. You are paid for the quality of the decisions you make. And even that is not immediate. Sometimes you make a good decision and the market disagrees. That's okay. Your job is not to demand that probability pay you instantly. Your job is to keep showing up with the same quality of decision making. This is why I don't look at a risk to reward strategy as a shortcut to profits. I look at it as a framework for survival. If I can control my losses, if I can avoid emotional position sizing, if I can wait for trades where the potential reward makes sense, if I can accept that some trades will fail, if I can avoid turning one loss into 5 trades, then I give myself something incredibly valuable, time and Time is one of the most important advantages a trader can have because skill needs repetition, understanding needs experience, emotional control needs exposure. You cannot develop those things if one bad week wipes out your account. Protect the account, protect the mind, stay in the game. That is the foundation. So when you look at your next setup, don't immediately ask, how much can I make? Pause, ask, where am I wrong? Then ask, if that happens, how much will I lose? Then, where is the realistic opportunity for profit? And finally, can I emotionally accept the loss without changing my behavior? If the answer is no, reduce the risk or don't take the trade. There is no shame in that. You don't have to prove anything to the market. You don't have to make money today. You don't have to catch the move everyone else is talking about. You don't have to recover yesterday's loss today. And you certainly don't need to make every trade work. Your job is much simpler. Protect your capital, protect your decision making, wait for opportunities that make sense, accept the losses that come with the process, and let the mathematics play out over a large enough sample of trades because trading becomes much less mysterious when you stop treating every trade like a prediction. You are not saying price will definitely go there. You are saying, this is the opportunity I see. This is what I am willing to risk. This is where my idea becomes invalid. This is where I believe the opportunity becomes less attractive. And if I am wrong, I will accept it. That is preparation, not prediction. And perhaps that is what most traders miss. Risk to reward isn't really about making more money on winning trades. It is about making sure your losing trades don't control you, because when losses don't control you, you stop chasing. When you stop chasing, you become patient. When you become patient, you become selective. When you become selective, your entries often become cleaner. When your entries become cleaner, your risk becomes easier to define. And when your risk is defined, you no longer need every trade to work. You can finally allow probability to do its job. That is when trading starts to feel different. Not easy, different. You stop looking at the market as something you need to conquer. You start looking at it as something you need to participate in carefully. You stop trying to predict every move. You start preparing for several possible outcomes. You stop asking, how can I win this trade? And you start asking, how can I make sure that one trade cannot damage me? That question is powerful because once you know you can survive the loss, you no longer need to fear it in the same way. And when you stop fearing the loss, you can finally execute, not perfectly, not without emotion, but with structure. You can lose and remain calm. You can win and remain humble. You can miss a trade and move on. You can wait while everyone else is trading. You can close the platform when there's nothing worth taking. And you can come back tomorrow. That is what risk management gives you. Not certainty, freedom. Freedom from the need to be right. Freedom from the need to trade every day. Freedom from the need to recover immediately. Freedom from the emotional pressure of making one trade carry your entire financial future. And once you have that freedom, something else becomes possible. You can finally learn because you are no longer fighting every loss. You are studying it. You are no longer celebrating every win as proof that you are a genius. You are studying it. You are no longer changing your strategy after a few bad trades. You are collecting evidence. You are becoming a student of your own behavior. And that is where real progress begins. Maybe your strategy is not the problem. Maybe your entries are not the problem. Maybe the market is not the problem. Maybe you simply have not learned how to lose correctly, because losing correctly is part of winning consistently. You accept the loss. You protect the account. You review the decision. You learn. Then you wait for the next opportunity. No revenge. No desperation. No doubling down. No emotional negotiation. Just the next decision. And then the next and the next. That is how a trader slowly changes. Not through one incredible trade. Not through one secret setup. Not through predicting the market perfectly, but through hundreds of small decisions where they choose preparation over prediction, patience over FOMO, process over emotion, and controlled risk over excitement. So the next time you see a trade that looks perfect, don't rush. Take a breath, look at the chart, ask yourself where the idea fails. Ask yourself what you are willing to lose. Ask yourself whether the potential reward is realistic. Ask yourself whether you would still take the trade if you knew the outcome was uncertain, because it is uncertain. It always will be. And that is okay. You don't need certainty to trade. You need a plan that can survive uncertainty. That is the difference. The market will always have another move, another high, another low, another breakout, another reversal, another opportunity. You don't need to catch them all. You only need to protect yourself long enough to recognize the ones that truly fit your plan. And maybe after enough time, you will realize something that took many traders years to understand. The goal was never to find a way to win every trade. The goal was to build a way of trading where no single loss could take you away from the game. Because once you stop trying to avoid every loss, you stop being controlled by fear. And once fear stops controlling you, risk to reward stops being just a number on your calculator. It becomes a way of thinking. You stop asking how much the market can give you. You start respecting what the market can take, and that is where real trading maturity begins. You don't become a better trader by learning how to win every trade. You become a better trader when you learn how to lose without losing yourself.